This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. Today on the show, I have Kathryn Kaminski. This is Kathryn's second visit to my show. She came on last year discussing her new book. Today, she's discussing a new white paper, specifically diving into correlation among traders. A deep dive, but a really important critical distinction that she makes in this new research. Also, Kathryn recently joined Campbell and Co, one of the oldest, if not oldest, CTAs in existence, with much trend following expertise dating back to the 1970s up to today, never stopped, a very successful firm. I hope you enjoy this conversation with Kathryn Kaminski. Kathryn, today, and I think people really need to go back and listen to our first conversation, but today what I really want to get into is you've got this cool white paper that you put out at Campbell and Co called Return Dispersion, Counterintuitive Correlation, subtitled The Role of Diversification in CTA Portfolios. I really did not know what I was walking into as I started underlining and going through this about a 10-page white paper. But I started to realize there's something really interesting, and you're going to be able to kind of flesh this out. But over the years, I have noticed, and I'm sure other people have noticed too, that when there are big performing months in the CTA managed futures trend following space, that often managers that might have high correlation don't necessarily at those opportune times don't necessarily always have correlated results right at that very opportune time for that particular type of strategy. Am I onto something? Is this where you were diving into?
What happens is you have a strategy space where most of the strategies are very diversified. So when you have such diversified strategies, we try to explain that therefore the correlation will be high between the strategies on average a lot of the times. But what happens is that specifically when people want performance, so a year like 2014, which is a great year for the CTA space, the strategy in terms of performance can be all over the map. That's kind of counterintuitive to a lot of investors who say, well, I thought that, A and B and C were all the same, but yet when I really needed and really got performance, A was over here, C didn't do anything, and B was, who knows, so I think this is sort of a counterintuitive issue in the CTA space, which has to do with the fact that momentum as a premium is a little bit, it can come in spurts and periods like 2004. And when that happens, it turns out that we tend to be those little differences between how we do risk management, between what we focus on, seem to sort of be exacerbated in these moments. And
when you just said 2004, you meant 2014.
2014, yeah.
Let's before we dive into it though, let's take a bigger step back and let's just talk about, for example, because you mentioned this in your paper, 2014 was the return, so to speak, of these types of strategies. Now, for someone you've written a great book with Alex Gracerman about trend following with managed futures, but why don't you talk about the notion that how, just like within the last few years, we've seen the titles, these strategies are dead, and then all of a sudden they're back alive in 2014. That predicate to begin with is off. I mean, the media's understanding of these types of strategies is off to say that a down period, it's dead, and then when it has an up period, it's alive. But the reality is, anyone that looks at the performance track record of this style of trading is going to see this variability from the outset.
Yeah, I mean, I think it's a natural human tendency, especially for strategies where one of the biggest challenges that we have in the systematic space and in the CTA space is that if people see us as a black box, they're much faster to throw the black box away. It's sort of like the television that, it doesn't work. And some people's solution to that is to hit the television or to, so I think if you don't when you understand how the strategy works and you get used to it and understand how to use it over the long run, of short periods of, or even long periods of underperformance, if they're not really, really out of the norm, would be expected for pretty much anything that you invest in. The same thing happens in stocks, but somehow we seem to be less upset about that. And I think that has to do with the fact that we understand and we feel like we understand how stocks work. So we naturally more accepting of drawdowns in things that we feel comfortable with.
You bring up stocks. Why don't we talk about diversification from a 36,000 foot peak for a moment, and talk about diversification as commonly understood in the equity world, the benefits, how it works, and why don't you transition that type of thinking over to the CTA world in terms of diversification as well?
I think that's a really good point. We've sometimes, some of my colleagues, and even in the past with friends in the CTA space, we tend to have a very different view about how we do diversification, in the sense that we tend to focus mostly on risk. And we see that return, for example, is really difficult to predict, but risk is something that you can at least manage and control. And I think that when we deal with diversification, what we're trying to do is spread our risk across as many opportunities and use as much information as possible to predict the level of risk. And in rare cases, the predictability of return. I think that the standard traditional economic framework for dealing with stocks and bond allocation is more, you have a return target, and then you minimize your risk as a function of the return target. We sort of, from past experience, tend to think that diversification comes from allocating across risk. And a lot of the research has shown that risk is a much easier thing to sort of attempt to measure and attempt to control than return.
I think one of the interesting things you do in this piece as well is you say that, look, there can be one core, for example, if we're talking trend following, there could be one core trend following strategy. There could be varying levels of risk chosen. There could be various parameter sets. The timing of those returns could differ. And I think what's really interesting, that you kind of a novel way of saying it, is that one trend following strategy is conceptually similar to one stock.
Yes. And I really like that analogy, because what you can say then is, if you invest in one stock, you have tons of idiosyncratic risk in terms of just the sort of noise and risk that you're not getting paid for. So if you have one way of investing in trend following, so one strategy, one set of parameters has the same level of idiosyncratic risk. And so how we build portfolios is to add as many of those as possible. That's why we have to be systematic. Because if we're not, then we have too much idiosyncratic risk, because the risk-reward trade-off in such competitive markets like futures, and I think you've probably had other discussions with people about this, trend follow one asset. It's tough.
It's impossible. Trend following one asset is buying and holding the S&P.
Yeah. So that's the issue, is that if you can't sort of combine those parameters into a portfolio, then you end up with too much idiosyncratic noise. So for someone who's new to this space, you can do a simple analogy and say, it's like one stock. If you invest in only Apple, you're going to be all over the place. You may have still an okay strategy, but the risk is going to be too much.
Yeah, but from a diversification standpoint, though, I think the analogy is really cool, but the one stock is generally one stock. But even if, let's say, one particular trend following strategy employed by a manager is just one set of parameters, at least that performance stream is being generated by a diverse portfolio. Whereas, I think it's still interesting to make that comparison to one stock. But I guess it's not exactly a true one-to-one comparison. But I think for the purpose of getting people to think about diversification, correlation, etc., I think it's very useful.
Well, the reason this is such an apropos topic as well is that there's been a lot of discussion. I'm sure you've had discussion on this topic as well about, okay, well, momentum is simple. I can give you the rule, and here's the rule, and, that's all you need. And that sort of is a challenge because we see investors asking us a lot of questions about, what's right for me? Should I have a very simple trend program with, very low fees, or should I have a highly diversified trend, non-trend, and complex, a hedge fund strategy? So I think this is another reason why I thought this was an important thing to think of now, because a lot of people are reading about trend following, learning it, and then thinking, well, I can just do this myself, or I can use this product or that product. And I think that the diversification is where the difference is. We have to remind them to diversify. No matter how they do it, it has to be diversified.
And even though you're at Campbell, and this white paper is on Campbell letterhead, you're really not prescribing a solution here. I think what you're more than trying to do is to generate a conversation, get people thinking about these issues, right?
Yes. And the reason for that is that, honestly, investors are heterogeneous. They have different needs, different wants, different solutions that work for them. But I wanted to sort of say more that they need to understand that diversification you have to be successful in the CTA space, and that there's definitely plenty of ways that you can do it, but it's important to remember that. And the other thing that we focused on, which really bothered me, was this conditional correlation issue. Because a lot of people, when they look at the correlations between managers in this context of CTAs, they assume that high correlation means that you're always going to get the same result. That's something that sort of has been sort of assumed as a causality, like, oh, high correlation means same results. But what we show is that high correlation breaks down in periods where you perform. So that means that the only way to protect yourself from that is actually to make sure that you're not just replicating the correlation, but actually diversified across a whole set of strategies so that you can replicate the performance.
I used to make these eyeball correlations over the years, looking at managers, especially at these opportune months or periods. And you could see over time for a particular set, I don't know, maybe 2, 3, 4, would often, even though they could be separated by oceans and have no connection, they truly seem to be, even at the opportune times, their correlation in a good way was right there. But you would clearly see times and events where you'd be like scratching your head going, okay, I know there's leverage differences and parameter choice differences, and people are trying to time when they decide to slice their section of the trend, but you would still shake your head and go, something's unusual so I guess it becomes really tricky and interesting. And I could see the minefield of data to be crunched here. If you start to look at a large number of managers, it starts to get fairly complicated quick, doesn't it?
What I see is a challenge I used to be an allocator, now I'm at a CTA, is that one of the reasons I wanted to go and work at Campbell is because I'm on the front lines and I get to see all the information. And my ultimate goal is to help find better ways to explain these differences, to explain and understand what causes differences between CTAs and how can we improve our systems. I think that's the challenge for the investors, is that, we do look a lot alike, but not all the time. And that's something that, this type of result shows that it is actually very important to understand the subtle differences between managers, between products that momentum trading, between your system and your ones that you're invested in. And I think that gives some pat on the back to the manager selection people that, this is an important thing that they're doing to understand the differences. It gives some credit to the manager selection teams and the allocators in our space who really need to do a lot of hard work to sort of dig down into the details to understand how we are different from each other and what are some of the sort of key issues to think about.
It really is it's such a big picture, fascinating angle, because whether it's eyeball correlation or crunching the correlation in Excel, you really do see some high correlations. But you looking at the magnitude of the differences at those critical junctures is fascinating, because things do break down. Look, somebody might still have a fantastic performance, but then one of their peers might be head and shoulders above, and then you start to scratch your head and you say, hold on, the correlation is really high, but the actual performance, the absolute return is quite different.
Well, what we find, and I think, what this paper hints at, is that there actually are some slants and tilts in terms of how we allocate risk, which can drive these differences. And this is a little similar to some of the work that I had done in the past with Alex on styles, but ultimately we all sort of have a slightly different footprint in terms of certain small factors. So you can take correlation as an example. Let's say that one firm is very, very sensitive in terms of risk allocation to correlation. And then another firm is slightly less sensitive. When you have a really large change in correlation, for some period of time, this can actually cause a dislocation between those two strategies. But usually this dislocation is somewhat temporary, and it will last over maybe a month or two. So let's say something happens, and it happens to be a situation where correlation is very, very important. And modeling correlation is good for this set of strategies. Then that set of strategies will outperform the others. But over the long run, what you see is that, it varies depending on what happens in markets. And it's very difficult to predict whether trends are going to come from correlated markets or if they're going to come from individual markets. And I think that's sort of the subject of current research that I'm doing right now. Because I think that is sort of connecting to risk management is a very important way that we can help understand our performance over time.
One last question for today, kind of a curiosity type thought on my own here. And don't beat me up if I don't recall if it's in your book with Alex on page 456. Don't beat me up if I don't recall. But what was the inspiration for this direction? What was the aha moment that kind of got you going down this path for this particular white paper we're talking about today?
For the white paper?
Yeah.
Yes, that's a very good question, because on page, just kidding. No, actually, we have a chapter called Return Dispersion. And this chapter is really, it's quite deep. And it looks at return dispersion in the CTA space and tries to explain that, return dispersion at the levels we see is to be expected between correlated assets. But one thing did stick out to me, which really sort of got me to think about this paper. There was a graph where we conditioned return dispersion, so how spread out managers were, as a function of volatility. All the plots on this point were very, very close together, with the exception of one. And that one point was 2008. So it was almost like there was this one situation which just didn't fit into the norm. Now, granted, was a yearly study. So if you go at a yearly frequency, you lose a lot of sort of short-term fluctuations, right? So I thought about that, and it always bothered me. And then when we started looking at return dispersion at a higher interval, we came up with a really interesting metric to estimate correlation point-wise, so on a monthly basis. And you might have seen this in graph 6 in the paper. And when we saw that, what we saw is that implied correlation was very stable over time, but implied correlation just broke apart from time to time in our sample. So that's where sort of the thought came about. This one graph that really bothered me in the book. We didn't talk about it, but it always sort of stuck out, that one point. And then I went back and thought about it again and sort of came up with the results of this paper.
Yeah, because over time, over years, like I say, kind of even eyeball and even some Excel correlation. But I often looked at differences, and sometimes you could directly attribute those differences to leverage choices, but other times you just knew it wasn't a leverage choice. There was something else going on.
Yes, and I think the problem is, and we talked about this in the paper, the problem is that correlation as a measure is not a good way to capture let's say you have a return series, like a correlation series, where you're correlated all the time and occasionally that just breaks apart. If you have a rolling correlation, you won't pick it up. It just sort of will roll down and roll up again. You won't see it as one point causing the entire change in the entire series. It kind of muddies the waters. So when we did this by looking at the cross section on a monthly basis, it was funny because I had some allocators that said to me, I said to them, this is more like how it feels to allocate to CTAs. And they said, yes, this is exactly how we feel. Everything seems the same. And then 1 month comes around and occasionally we're not sure why they're so different. And that kind of told me that there is something to this explanation.
Everybody can find the paper as of right now on the Campbell website. I think this last line, though, I'm going to read. People can go read the paper. I think probably one of the best things is for people to even jump in first. Maybe I'll even say that at the introduction. They should read the paper first. But I love this.
It's only 6 pages. So that's good.
I love this last line, though. High pairwise correlations may underestimate the importance of diversification in CTA portfolios, leaving portfolios undiversified in critical moments for performance, end quote. And that sums it up. But that's a big thought. And I don't think a lot of people have really sat down and chewed on that one yet.
So I think what we could say is we say that, if you assume that all strategies are the same, you may miss out in the right moments. That's maybe an easier way to say it. But if you assume that all things are the same, you may miss something. So you need to dig a little deeper and you need to make sure that you have a very diversified approach to investing in the CTA space.
Kathryn, you have once again promised there are no free lunches. Where can we send people? I assume the Campbell website, which is campbell.com, right?
Yeah, they can just check out the paper on campbell.com, or if they have any questions, they're free to email me. My email should be on the paper and also, on the website.
Kathryn, it's always good talking. Hopefully we can talk again when you write more cool stuff.
Great chatting with you, Michael.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.